Hello, everyone, and welcome to the BP Learning Channel. Today, we are here to talk about the legal structure of a business, something every new business owner must consider when launching a business venture. We are going to examine some basic pros and cons of 6 legal structure options, and then we'll talk a little about some common practices. If you've been here before, then you know that I'm Debbie, a certified SBDC coach at the Business Incubator Center, a partner with the Colorado Small Business Development Center under the SBA. I'm also a former business owner myself, a former CFO for multiple startups in the Silicon Valley, and a CPA with a master's in finance. And I'm here today to help you understand the legal options available for a business structure and talk to you a bit about how you establish whatever structure you might choose without getting yourself into trouble. I'm giving you the basics today, what you need to know to get started. And now, let's get started. The legal structure of a new business venture, the pros and the cons. Which one should I be? We're going to talk about 6 different kinds of structures today. A sole proprietorship, a general partnership or GP, a limited partnership or LP, a C corporation, a C corp, a subchapter S corporation, an S corp, and a limited liability company, an LLC. This is something every new business owner must consider before launching a business. The entrepreneur must carefully weigh the pros and cons of each one, and then choose a structure that offers the right balance of legal protection and benefits. First, let's talk about a sole proprietorship. A business owned by an individual, one person. Importantly, a sole proprietorship is not a separate legal entity. No formation is required. It is merely a separate entity for accounting and tax purposes. The business itself is not taxed. Rather, the owner of the business pays taxes on the business profits, and this profit and loss is reported on Schedule C of Form 1040 when the owner files his personal tax return at the end of the year. And even more important, the individual who owns the business is at risk. There is no limited liability. And what does that mean? Limited liability is a legal status in which a person's financial liability is limited to a fixed sum, most commonly the value of a person's investment. Let's review the attributes again of the sole proprietorship. It's not a separate legal entity. The owner pays taxes on profits. The profits are reported on Schedule C of Form 1040, and there is no limited liability. So, even though this is a common form of ownership, you should only choose this business form if you are not worried about getting sued. Next are partnerships, general and limited. A partnership is a business owned by 2 or more parties, entrepreneurs, often choose a partnership as a business form in order to maximize expertise, pool resources, share knowledge, and raise capital. The partnership itself is not taxed. Rather, profits pass through to owners on a Schedule K-1 when a Form 1065 is filed for tax purposes at the end of the year. Partnerships are pass-through entities for tax purposes. In most cases, there is a written partnership agreement that describes ownership sharing, contribution and distribution requirements, management rights, sale and liquidation terms, and transfer rights. Let's take a look at partnership attributes for a general versus a limited partnership. 2 or more owners are required. Yes for general, yes for limited. It is a pass-through entity. A Schedule K-1 goes to investors at the end of the year. Yes for general, yes for limited. There are suitability requirements. A partner must have a certain net worth or a certain net income, or both. Maybe in a general partnership, and almost always yes in a limited partnership. The entity is not perpetual. That means it may terminate if a partner withdraws. Yes for general, yes for limited. There is limited liability. Liability is limited to the amount of investment by an owner. No for general. Yes if you are a limited partner in a limited partnership. The owner has management control. Yes for general. And no if you are a limited partner in a limited partnership. Note, every limited partnership requires a managing general partner. This general partner has unlimited liability. In general partnerships, management responsibilities are assigned to a designated partner in the partnership agreement, and all partners have unlimited liability. And finally, transfer rights may be limited. A partner may not be able to transfer his interests or withdraw from the partnership. Yes for general, and yes for limited. Next up are corporations, a C Corp and an S Corp. A corporation is a business owned by 2 or more shareholders. Let's review corporation attributes for a C Corp versus an S Corp. There is limited liability. That is, liability is limited to the amount of investment by the owner. Yes for a C Corp, and yes for an S Corp. The entity is taxed. There may be double taxation. Yes for a C Corp, and no for an S Corp. In a C Corp, not only is the entity taxed, but when the shareholder receives a dividend, the dividend is also taxed. The entity is perpetual. It continues after stock transfers to a new owner. Yes for a C Corp, and yes for an S Corp. There are formalities. Articles of incorporation, bylaws, minutes, and a board of directors are required. Yes for a C Corp, yes for an S Corp. There are limits on who can be a shareholder. Partnerships, LLCs, and corporations cannot be shareholders. No in a C Corp, and yes in an S Corp. There is a limit on the number of shareholders, a limit of 100 shareholders. No in a C Corp, and yes in an S Corp. Multiple classes of stock are allowed. You can have common stock and various classes of preferred stock with different ownership rights. Yes for a C Corp, and no for an S Corp. Owners can be on the payroll. Yes for a C Corp, yes for an S Corp. Dividends are taxable. Shareholders receive a 1099 at the end of the year. Yes in a C Corp, and no in an S Corp. The corporation is a pass-through entity. Owners or shareholders receive a Schedule K-1 at the end of the year for tax purposes. No in a C Corp, and yes in an S Corp. Both vehicles are corporations, but as you can see, they are very different legal entities. And finally, we have a limited liability company, or LLC. An LLC is a business owned by one or more members, depending upon state requirements. Entrepreneurs often choose an LLC as a business form in anticipation of a public offering or possible merger transaction as an exit strategy. Similar to a partnership, an LLC allows owners to maximize expertise, pool resources, share knowledge, and raise capital. The LLC is a pass-through entity. Just like a partnership or an S Corp, profits pass through to owners on either a Schedule C of Form 1040 if it is a single-member LLC and the owner chooses to file that way, or on a Schedule K-1 when the LLC files its tax return. And similar to the partnership, there is a written operating agreement that describes ownership sharing, contribution and distribution requirements, management rights, sale and liquidation terms, and transfer rights. Let's review LLC attributes. The entity is not taxed. Profits and/or losses pass through to members. Owners enjoy limited liability. It's much harder to get sued. The entity may or may not be perpetual. It depends upon the state the business is operating in and/or on the operating agreement itself. A written operating agreement is required and highly recommended. Owners can be on the payroll only with an S Corp election. An owner generally cannot be on the payroll in an LLC, but if the LLC makes an S Corp election for tax purposes, this allows the owner to be on the payroll. Check with your tax professional about doing something like this. Multiple classes of ownership are available. You can have various classes of membership units with various ownership and management rights. There is no limit on the type or number of members. And it's just easier to sell or go public in this form. That's why this is generally the vehicle of choice for most entrepreneurs. Companies planning to thrive and grow are almost always an LLC. And now, let's talk about some compliance considerations that can make or break your business. I want you to stay out of jail. I want you to understand and follow the rules. We talked about 6 different legal structures for a business today. 5 of them require forming a legal entity independent of the business owner. All of them require compliance with legal and tax regulations, including the payment of fees and taxes and filing of reports. Importantly, you need business identification numbers. When an independent legal entity is formed, owners are required to obtain an employer identification number, or EIN, at the federal level, and in most states, a state identification number. All businesses, except for sole proprietorships with no employees, must file for an EIN number with the IRS. This can be done online. State tax ID numbers are required in most states. This can usually be done online. In Colorado, it is assigned as part of the entity formation process and requires a federal EID to process. And now, the other important area I want to talk about today: business operating agreements, agreements in writing. Make sure you have a comprehensive written partnership and/or operating agreement for your business if you have more than one owner. Clearly spell out the terms of business activities and ownership rights. Not only will this keep you out of jail, but it'll keep you out of the court system with lawsuits between owners of a business vehicle. These agreements should spell out ownership sharing, contribution and distribution requirements, management rights, suitability requirements, sale and liquidation terms, voting rights, and transfer rights. Choose a structure and understand the operating rules before launching a business. Okay, let's talk about how you choose your legal business structure. We've been through the basic pros and cons of 6 different legal options, and there's a lot to think about, no doubt. But let's step back for a moment and put all the information we have in perspective. Big picture, you're launching a business, making a business investment, and so why not make the legal structure decision by measuring your tolerance for risk or liability versus whatever potential profitability reward you hope will be there. Here's how this kind of thinking works. In wrapping it up, we choose a business structure by assessing our risk tolerance versus the reward we hope to get. How much risk are you willing to take for what kind of reward? This is a question that every business owner should ask and carefully answer as part of a feasibility assessment before launching a business. Why? Because the results of an assessment like this will dictate what kind of business structure you need to help you accomplish your mission. Bottom line, you should be looking at numbers before making this legal structure decision and launching a business. This effort will help you measure profitability and assess the relative risk you are willing to take. Let's talk about risk first, in context of liability, and then we will talk about how your risk tolerance intersects with reward, a profitability measurement. In a sole proprietorship or a general partnership, there is unlimited liability. You could effectively lose everything, all of your savings, investments of any kind, and even your home. In a limited partnership, as a limited partner, your liability will most likely be limited to the amount of your investment at any point in time. But you will need at least one limited partner and a general partner manager. And if you want to be the primary owner, that is, you want management control, you want to call the shots in this business, then you will have to be the general partner manager with unlimited liability. Now, you can distance yourself a little from this kind of risk by using legal layering techniques used in the Silicon Valley all the time. Layers and layers of legal entities to minimize risk and protect ownership rights. But it's complicated and very expensive. You will want to get a tax professional and a lawyer involved to go down this road. So, let's look at limited liability instead. A C Corp, an S Corp, or an LLC all have limited liability, but a C Corp exposes you to possible double taxation, and an S Corp limits your fundraising opportunities due to the limitations on the number and type of investors. That leaves us with a limited liability company, probably the most common legal entity used in the Silicon Valley. Why? Because it's a pass-through entity with limited liability and it's incredibly flexible. Let's connect the dots now between risk and reward. Okay, I'm going to make this simple and tell you what I did when I launched a business in the Silicon Valley. None of the unlimited liability choices were an option for me. There was just too much risk involved. But your answer might be different than mine. There's more than one answer here. I'm just very risk intolerant. And these are definitely all higher risk options. My goal was to maximize business performance and exit the business with a fair amount of wealth. So I chose a flexible structure, one that allowed me to thrive and grow. I chose an LLC, a lower risk option. And that's it, folks. You now have the basic information you need to make a good decision regarding the legal structure of your business. If you still have questions, however, you might want to talk with a lawyer or tax professional, someone who specializes in legal and tax issues related to small business startups. There's a lot to know. There's no doubt about it, and laws and regulations change on a regular basis. Maybe bring your SBDC coach along, someone like me. I visit professionals with clients frequently. But before you do something like this, take a look at some of the other tools available for startups on my website. The 3 handy reference guides regarding getting your books up and running, minding your cash, and assessing the vision you have. Assessing the vision is an excellent choice if you are in the early stage of launching a business. It's all about, guess what? Assessing risk and reward. Then, peruse all the strategic learning tools available for free on my website, projection models and finance keeping templates, including a feasibility analysis spreadsheet that goes hand in hand with the reference guide I mentioned earlier. And finally, peruse all my free videos. The one called How to Start a Business Without Letting Your Cash Go Up in Flames is all about doing a feasibility assessment. So you have a reference guide, a template in a spreadsheet, and a video. Bottom line, I want you to have the tools you need to assess a business opportunity, make a decision on a new venture like this, launch it, and manage it successfully going forward. So please, subscribe to the BP Learning channel before you go so you don't miss out on other prosperity tips that might be helpful. And thanks, everyone, for listening today. I'll see you the next time.